of what is happening in the market right now. So, are we expecting a rate cuts to come right away with all the economy data we've seen that's happened over the past 2 weeks? And what does it actually mean for both stocks and bonds, regardless of what you're invested in? So, this will give you an idea of how to position your portfolio in the next 6 to 1 year as well. So make sure you watch to the end of this video because it's going to have a lot of insights that you can take away right away. But before that, if you haven't already, make sure to like this video and subscribe to this channel as well, to my channel, because I'll be releasing one video every week talking about the market, and we're going to cover different aspects such as companies, stocks, macro data, so that all of you can get insights right away. Now, first off, to understand everything, we have to understand how does interest rate works and how does it actually impact the market. So interest rates, think of it as like the price of money. And when that price changes, it affects nearly every part of the economy. So first, think about mortgage, like your housing loan. So when interest rate rises, right, it becomes more expensive to borrow money to buy a home. So monthly payments will go up and fewer people can afford houses, and that can slow down the housing market. Next is credit cards and business loans. So when you have higher interest rates, right, it means that borrowing costs for everyday people and companies increases, right? Consumers might spend lesser, business might delay expanding and spending on marketing, and that slows down the economic growth overall. And last but not least, stock prices are also affected because these are companies, right? And when companies are affected in terms of their spending, it reflects in their profit margins, it reflects in their revenue, and that's how it affects the stock prices. So to use an analogy, right, it's like a thermostat, okay, or like our air condition. So this analogy helps us to explain why the Federal Reserve adjusts rates, and basically what they are trying to do is to keep the economy at a very comfortable temperature, not too hot or cold. So if the economy is too cold, which is like it's very slow, right, the central bank will actually turn up the heat, which lower rates to actually warm up the economy. Now, if it's overheating, right, there's inflation, right? What they do is they actually will turn down the rate, turn down the heat to raise rates to cool things down. Okay, so this is the general idea. Use this analogy to help you. Slow means cold. So what they do, they have to turn up the heat. And if it's hot, it means it's overheating. So then they have to turn down the heat. So use this analogy to help you to understand easier. Now, what happens to stock prices when the rates rise or fall? So very simple. If interest rate rises, what's going to happen to the cost of borrowing is going to be more expensive, right? Because you're going to pay more interest. And when the borrowing is more expensive, what does it mean for business spending? It will drop. They can borrow lesser money, which means they can only invest lesser in their business. And when business investment drop, consumer spending also drop, right? Because they cannot do a lot of sales and marketing, they cannot do a lot of outreach. And when consumer spending drop, this affects their revenues number, which then cause the general stock market to drop in all of these companies. So this is generally if we look at interest rate in a big picture view. Now, on the other hand, if interest rate drops, cost of borrowing will become cheaper, right? That means companies can borrow more money. And when companies can borrow more money, that means they can invest more into their business, into sales and marketing, into R&D, into developing new things. And when there's new things, new marketing initiatives, and new exposure, right? This means consumer spending will also increase, right? And when consumer spending increase, it then leads on to the numbers doing better, which then leads to the stock market going up overall. So this is that whole idea, right? So even though we might not notice it day to day, interest rates actually silently shape everything from big purchases like home to the overall value of business in the stock market. Now let's look at what is happening now and the actual Fed's deadlock. Like what are they stuck with? So right now, if we look at the overall interest rates, right, you can see that the Federal Reserve has held the interest rate steady at 4.25 to 4.5% for a fifth straight meeting. Okay, so previously it actually peaked back in mid 2024, right, at 5.5 around there, but it has since gradually come down to 4.25 to 4.5. But take note as this important thing over here, generally for the Federal Reserve, right, the consensus of the overall team is quite fair. But in this particular case, right, two governors dissented in favor of a cut. That means basically what they're saying is, hey, I think that we should go and cut the interest rate. So that means there's some disagreement happening, right? So this is the current thing, right? And the idea of what basically Trump wants, which you will see later, is he wants interest rate to drop. But let's look at the other data that we've seen that has come out after that for the Fed to make a more informed decision. The first one is this monthly jobs creation, what we call the non-farm payroll, which actually released, I think sometime last week or slightly less than 2 weeks ago, where it actually was lower than expected at 73K. And on top of this report, right, the labor data report, right, what they did, they also they were also able to revise the past 2 months of data because there was more data points for them to do, and they actually revised it way lower, right? You can see it's the lowest out of like 2022, right? And by combined, it was reduced by 250K in combined. So this means there are lesser jobs being created by the economy. And at that point, it kind of spooked the stock market a little bit, because when there's little jobs created means what? That means there's not a lot of people getting a job. There's no companies are hiring. Why are no companies hiring? Because maybe numbers are doing well, budget is tight. So these are what is happening. And I think that right now, if you go and ask around, right, the job market is a bit hard right now. Okay, so this is in the US as of July 2025. And we're going to look at the CPI, which actually just released yesterday. So there's two lines. Okay, so the lines above, right, is what we call the core CPI, CORE CPI. And the line below is just what we call CPI. So what is the main difference, right? Core CPI actually exclude food and energy, whereas because it's much more volatile, right? Whereas the CPI includes both food and energy. So you can see the CPI actually came in at 2.7% year on year, pretty unchanged from July and looks pretty mild. But when you look at the headline CPI, which is what the Federal Reserve looks at, right? Including food and energy and everything, right? You can see that it is at 3.1%, up from 2.9% in June. So that is the part that is worrying, right, for the Federal Reserve, that it's not coming out as fast as they like. So while the core CPI is above target, the headline CPI is holding at 2.7. And that is what the public and what the market is reacting to. Okay. So the falling energy and food costs, right, with it maintaining, right, it made the overall inflation environment like less threatening, which then can justify a rate cut politically and psychologically. That's why when these results were announced yesterday, stock market actually was green, right? Because people feel like, this is not so threatening, right, in terms of inflation. So then it increases the odds of the rate cut. So the market has already kind of like priced that in the September rate cut, which are coming out in about a month here. Okay, so but one thing to take note is that it didn't increase as much as some people feared, right? So in the short term, market will likely embrace these numbers because it allows the Fed to focus more on the labor market weakness and monitor that September rate cut lah. Okay, and even Donald Trump, right, he has came out and said that after the result, just 15 hours ago, Jerome Too Late Power, okay, he's giving him a nickname lah, must now lower the rates. Okay, so you can see, right, on top of the Federal Reserve seeing all this data, he's being pressured by Donald Trump. But this has been happening over the past few months. And Jerome Powell, I think he's a guy that follows the numbers very, very closely. But from what the numbers we are seeing now, right, even the consensus of what people are feeling, right, is that now the probability of a September rate cut, 17th September, is at 94.3%. Okay, so you can see now it's 4.25 to 4.5, and the odds of it dropping to 4.25 is now at 94.3%. So the markets are already pricing in the 90% chance of a September cut, because investors see rising unemployment, slower growth, and mild headline inflation. So they are betting the Federal Reserve will move to prevent a hard economic landing, right? Because if unemployment is higher, right, what would spur the Federal Reserve to actually spark the economy is they will allow companies to borrow more money, right? Borrow more money means what? They can hire more people, and that will help with unemployment. Okay, but apart from this data, right, okay, they don't just only look at these two data to make a decision. Okay, they monitor four main areas. Why? Because they need a full picture before they touch rate. Right, cannot be you study, they know two ideas and they make a decision that affects everyone. No, there are a lot of things that look at apart from the consumer side, apart from the inflation side. Okay, now, before that, right, I want to invite all of you to join our Buffer Online School Telegram. Okay, so in the Buffer Online School Telegram is where we share kind of like market insights and content for you to follow through. So we basically help you to keep track of the market in very fast, right? Because we are always looking at the market. So be it economy data, be it companies that are reporting earning, and also sometimes we also share some of our personal finance things, or how you can optimize your personal finance, share about some of the life experiences that you have. So it's all for you to kind of learn and take away some stuff over here. So be sure to follow us on to to just pause this video right here and just scan on your phone to join our Telegram chat. Now, let me move on, okay? So the key economic indicators that the Fed looks at. So the first one they look at is actually inflation. Okay, so inflation, they look at the consumer price index, the CPI, which we just shared. And second is what we call the personal consumption expenditure. So this is where they track consumer spending more broadly. Next is economic growth. So this one, they see how the overall economy is growing, which is GDP, right? Total output of the economy, how much is growing or shrinking. Next is employment, which is the non-farm payroll or the unemployment rate, both. So non-farm payroll is what you saw earlier, whereas unemployment rate, this is also important. It measures the percentage of the labor force that is jobless and actively looking. So the Fed also will monitor this very closely. Last is business activity, okay, which is the Purchasing Manager Index, the PMI. So it reflects the health on the manufacturing and services sector. So you can see these are the current data, the core CPI, which is what you see earlier. Core PCE, okay, so this is as of last updated as of June. Okay, so we are waiting to see what is happening in July, right? So if core PCE is going higher, right, it means that inflation is still very, very strong, right? And then the Feds might actually consider twice about the rate cuts, okay? But we're still waiting to see what the results of it will be. Next is employment. You've seen the non-farm payroll. Unemployment rate, you can see right now is standing at 4.2%. It has been around 4.2 for a while. So I think that generally people are waiting to see this. The Federal Reserve is waiting to do this. If unemployment rate increases, then it makes the Federal Reserve want to cut rates, the odds of it even higher as well. Economic role, GDP, very straightforward, but you can kind of see, right, that the economy is actually growing at a slightly slower rate over the past 2 quarters as compared to earlier as well. Okay, but this is something they actually look at as well. And last but not least is the PMI, which they basically track how manufacturing is, both manufacturing and services in the United States. Okay, so think of PMI like a pulse check. So it's a leading indicator. It shows us changes in the business momentum before we actually see in GDP or jobs numbers. So what is actually happening this week? Okay, so this week, what is going to happen is that a lot of things. I remember that their decision will not happen because of what we've already seen. So this week, we've got key earnings reports, we've got more economic data drops, and I think Trump is also speaking tonight. So any of these could actually shift expectations. So the dilemma right now that the Fed is doing is that inflation is high. Inflation is okay, but the core inflation, the core CPI is still high. Next is the labor market is cooling, right? Because there's lesser jobs being created. Growth is slowing and the markets are all betting on cuts now. So the Fed has to decide right now, do they cut now and risk reigniting inflation, or do they hold rates right now? Okay, so what do you think they should do, right? What do you think is the next step in the Federal Reserve? Just let me know down in the comments below. I'll look at every comments as well. Now, for this week, okay, so what's going to happen? Today, there's no news. Today is Wednesday. There's no news. This is in Singapore time. So what's going to happen tomorrow is where we're going to look at the core PPI. Okay, this is where they look at inflation, like what I shared. Unemployment rate is going to happen again. Unemployment claims is going to show as well how much people are kind of like unemployed and claiming this kind of benefits. And on Friday, there's quite a few as well, which is the core retail sales. So this is measuring more of like the front end retail. And the next is consumer sentiment inflation expectations . So I would say the more important one is this factor over here. These are the ones. Consumer sentiment is how people feel about industry, which do give a bit insight. But if in terms of what the Federal Reserve will use to make their decision, it will mainly be this on top of what we've already seen as well. Okay, so that's all I have. Now, if you enjoy this kind of videos, you enjoy this kind of content, right? Follow me on Facebook and follow me and subscribe to me on YouTube, right? Okay, so you can scan it here as well. Just pause the video, scan it here. This is on YouTube, so just subscribe to me directly. But if you're on Facebook, feel free to just add me as a friend and follow me as socials, where I also share a lot more insights and content as well to be in more real time as compared to just one video every week as well. So I hope that you have learned something over here today, and let me know down in the comments what you think, what you're looking forward to, any questions that you have, and I will be sure to answer them as well. Okay, so I hope you have learned something here today.